When it comes to investing, especially in individual stocks, it is very important that you stay up with the happenings within those individual stocks, as well as the market as a whole. Well, in the past few weeks, we have seen turbulent times as we have seen 5 consecutive trading days in the red, the worst week since the lows back in fall of 2023. Given that, it is always important to maintain some sort of cash reserves because you never know when you're going to get an opportunity to buy a stock that you've been wanting to buy. And just as important, a top watch list stock. Do your due diligence ahead of time so that when those opportunities persist, you're ready to pounce. And in today's video, we're going to take a look at 3 high quality dividend stocks who are trading with great valuations. But before we begin, do me a huge favor. Click that like button down below. Show your appreciation. Also, consider subscribing to the channel so you'll be notified anytime we drop new content. And with that being said, let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 undervalued dividend stocks, beginning with dividend stock number 1, which is Abbvie, stock ticker ABBV. And if you've been watching me on this channel for any number of years, then you've probably heard me talk about Abbvie, as it's one of my favorite positions and one of my longest held positions. I've essentially held shares of Abbvie since it became a public company, relatively about a decade ago. It was a spin-off of Abbott Labs. Abbvie operates out of the healthcare sector. It currently has a market cap of $292 billion. And over the past 12 months, the stock has been relatively muted, up only about 3%. Year to date, shares are up 6%. However, over the past month, shares are down 8%. Abbvie is what I often refer to as an investor's trifecta. What does that mean, you might ask? Well, looking here at this chart, you can see that first and foremost, if you take away the dividend, they still offer a solid growth component. Looking at this 5-year chart, you can see that growth potential that Abbvie has provided, outpacing the S&P 500 by a wide margin. Secondly, once we bring the dividend back into the picture, you can see that for the majority of the past 5 years, the dividend yield has been above 4%, which is a solid dividend yield on the higher side. Today, the yield is at right about 3.8%. And lastly, I love dividend growth, and Abbvie for years has provided strong dividend growth. It's rare that you find a stock with a higher dividend yield and strong dividend growth. The company has a 10-year dividend growth rate of 14.1% and a 5-year dividend growth rate of 8.5%. For years, Abbvie had claimed fame to the best-selling drug in the world with Humira. However, since the start of 2023, Humira has lost patent protection. So those sales are down. Now all the focus is on 2 up-and-coming stars in Skyrizi and Rinvoq, who are expected to be combined larger than that of Humira. Now let's take a look at valuation, where looking out ahead to 2025, analysts are expecting the company to generate EPS of $12.10, which equates to a forward PE multiple of about 13.5 times. The 5-year average for Abbvie is only about 12. In terms of analysts' average price target, they have an average 12-month price target of $181.50, implying more than 10% upside from current levels. When comparing the PE multiple to its historical average, it doesn't look that undervalued or undervalued at all. However, this is a company that continues to grow its free cash flow at a high rate. It has free cash flow margins in excess of 40%. This here, folks, is a healthcare company that's going to see its PE multiple go from an average of about 13 to what I believe should be higher at around 15 or even higher than that. And that leads us to dividend stock number 2, which is McDonald's Corporation, stock ticker MCD. The Golden Arches. You've seen a McDonald's at least once in your life, probably once a day even. And if you haven't seen the movie The Founder, it's definitely one that you should go see so that you could see the backstory of how McDonald's came about. The company currently operates out of the consumer discretionary sector. It has a market cap of $195 billion, and over the past 12 months, the stock is down 7%. Year to date, it is down 9%. and down 3% over the past month alone. When it comes to McDonald's, although they fit into the consumer discretionary sector, they're really a real estate company. They're one of the largest landlords in the world today. All of those locations, McDonald's locations, the majority of them are franchise owned. However, the buildings they operate in and the land they operate on are usually owned by McDonald's Corporation, which they lease out to the franchisees. It's just a brilliant strategy when you think about it, and it turns into large sums of free cash flow. Looking here in 2023, you can see the company generated free cash flow of $7.3 billion, a record for the company, and a 33% increase over the prior year. When you hear those types of numbers, it may have an investor thinking, well, they probably just reinvested less. Their capital expenditures were probably down, and that certainly was not the case. In fact, their capital expenditures increased by 24%, and the company still increased free cash flow by 33%. Those strong free cash flow numbers ensure that the dividend is not only safe, but it should continue growing in the foreseeable future. Speaking of that dividend, you could see the company currently pays a dividend of $6.68 per share, which yields about 2.5%. They have a 5-year dividend growth rate of about 8%, and they've been growing their dividend for 47 consecutive years, knocking on the doorstep of becoming a dividend king. As for valuation, the stock looks rather intriguing. 2025 EPS estimates are $13.50, which puts the forward PE multiple at just 20 times, compared to its 5-year historical average of 26.7 times. In terms of price target, analysts have an average 12-month price target of $323 per share, implying nearly 20% upside from current levels. And before we look at the final stock on our list today, let me tell you about the Stock Investor's Edge. This is my newsletter where you can get weekly updates, even midweek updates, to give you all the information you need to not only get an edge in the market, but stay up to date. If you want to become an Edge Plus member, you'll get access to my portfolio. You will get portfolio updates, actionable alerts. In addition, each week we do a stock deep dive. We take one individual stock and do a research report showing you all of the financial data, as well as our thoughts on whether this stock is a buy, sell, or hold. So definitely check out the link down in the description below and become a subscriber to the Stock Investor's Edge today. And that brings us to our final stock on the list, which is ConocoPhillips, stock ticker COP. ConocoPhillips is an oil and gas producer, and it's a stock that I mentioned in a recent video titled Top Stocks to Buy in the Month of March 2024. Since I mentioned ConocoPhillips in that video, shares of COP have climbed 15%, and I don't expect them to slow down anytime soon. As I mentioned, ConocoPhillips operates out of the energy sector. It currently has a market cap of $150 billion, and over the past 12 months, shares are up 23%. Year to date, they are up 10%. So I know in today's video, we are looking at undervalued stocks, but from a fundamental perspective, ConocoPhillips isn't that undervalued. This is going to be an undervalued play on momentum. This is a stock with a lot of momentum. This is a stock within a sector with a lot of momentum. This is a stock that's going to continue rising with all the global tensions going on. We see Israel and Iran, we see Russia, Ukraine, and who knows what's going to happen between China and Taiwan. Oil prices in the low 80s right now. Don't be surprised if you see oil prices exceed $100 a barrel. And as those continue to creep higher, companies like ConocoPhillips print more and more free cash flow. Where does all that cash go, you might ask? Well, it helps fund a growing dividend. The company currently pays a dividend of $2.32 per share. It yields a dividend of 1.8%, and the company has very strong dividend growth with a 5-year dividend growth rate of 20%. As for valuation, again, not undervalued from a pure valuation aspect, but let's take a look at it anyways, where analysts are expecting 2025 EPS of $9.30 per share, which equates to a forward PE multiple of 14.5 times, compared to their historical 5-year average of 13 times. Looking at price targets, analysts have a 12-month price target of $143 per share, implying 12% upside from current levels. So there we just looked at 3 high-quality dividend stocks for you to consider for your portfolio. Abbvie, a healthcare company. McDonald's, a consumer discretionary, but really a real estate company. And then lastly, we looked at an energy play, ConocoPhillips, not undervalued from a fundamental perspective, but it has a lot of momentum that I don't think is going to slow down anytime soon, at least in my opinion. Down in the comments section below, let me know which of these 3 stocks that we covered today is your favorite. And if you haven't done so yet, please hit that like button down below. I truly appreciate it. And if you haven't done so, subscribe to the channel so you're notified anytime we drop new videos. With that being said, we'll see you in the next one. Take care.